Hi guys, welcome back to the channel. My name is Dave, and today I want to talk about a relatively new income-oriented ETF that I've been hearing lots and lots of rumors about. So this is a new ETF from NEOS. NEOS? I've never heard of NEOS until now. That's because they're also relatively new, formed back in 2022. But with everybody asking me about SPYI, I figured I'd do a quick little review of it and see if it's worthy of being in my portfolio, or maybe even yours. So if that is what you're looking for, please stick around. Whoop. Just to get started, let's talk about size. I'm a size guy. Let's talk about size. So JEPI is from JP Morgan. That's the big juggernaut in the room, right? And we're talking about assets under management when it comes to JEPI of about $26 billion. So that's a pretty big fund. And JEPQ comes in at about 3.45 billion. Right behind that, you've got Devo at 2.9 billion. And I'm going to throw a chart up here so you can see relatively how all these stack up. And then you've got the brand new SPYI from a brand new startup in NEOS, founded in 2022 with current assets under management of about $84 million. And total assets under management between their three funds that they have of, I don't know, about 200 million based on what I could see. So they are brand new. Now, that doesn't mean it's a poor product, but when you see it relative to what we're talking about with JEPI and JEPQ and DIVO, three that I talked about that I do own already, this is obviously really small. So I guess my first point is I'm not in a rush to get into this at all. I'll take my time getting into something like SPYI. I will let it mellow. I'm reminded of the movie Wall Street when Michael Douglas's character Gordon Gekko confronts Sir Larry Wildman, and Larry says, I could buy you 6 times over.
I could buy you 6 times over. I could dump the stock just to burn your ass.
Only in this case, it's big bad JP Morgan saying I could buy you 300 times over. So it's a much larger fund. I'm much more comfortable buying JEPI and JEPQ than I am buying something that's brand new to the market. So let's start out by checking out the NEOS website here, which they've dubbed the NEOS S&P 500 High Income ETF. Now this is one of those. It's not a covered call ETF exactly, but it is a monthly distribution that they put out every single month with an expense ratio of 0.68%. Now that's kind of in line with some of the QYLDs and RYLDs of the world, which again, I'm not a big fan of. I still go towards DIVO, which is also around that same amount. And then JEPI and JEPQ are about half of that. So that's a nice perk of those larger funds as well. They have a much lower expense ratio. 0.68 simply means if you invest $10,000, $68 of that is going to manage this fund every year. That's what these guys get for taking care of it. And it is a managed fund, so they're doing a lot with this when it comes to monthly distributions and the fact that they're managing all these option trades as well. So distribution yield shows is 12.29%, but again, we'll look at that over at Seeking Alpha to see how that fits in with what they've done thus far. 1.14% 30-day SEC yield. So if you take that times 12 monthly distributions, you kind of get an idea. But yeah, let's scroll down here and get some of the fun details because it's so fun. Now, as of 6/16 of 2023, this was just started, fund inception, 8/30 of 2022. We see the fund ticker, gross expense ratio we talked about, and here's our first clue here, net assets of $84 million. So again, a very small fund. We saw what that is comparatively. Now, this is based on the S&P 500 index as the title touts. Now let's look at these targeted benefits of SPYI strategy. The fund seeks to distribute high monthly income generated from investing in the constituents of the S&P 500 and implementing a data-driven call option strategy. So part of it is a call option strategy. Actively managed by NEOS, the fund seeks to take advantage of tax loss harvesting ideas, opportunities. I'm not sure exactly how that's going to fit into what they're doing. But then they're utilizing SPX index options. So that gives them classification of Section 1256 contracts So they're subject to 60/40 tax rates, right? So when you do index options, you get long-term capital gains and short-term capital gains. So it's more tax efficient. So that should benefit you. And that should probably offset a lot of that gross expense ratio of 0.68% and maybe get you a little bit more in line with what you might see over at JEPI, depending on if you're doing this in a taxable account. Again, just kind of thinking out loud as I go through this in my own mind. Now, the fund utilizes a call option strategy that may include both sold and purchased SPX index options, which may provide the opportunity to upside capture in rising equity markets. So I think that's the big hook with this one, the tax advantage, and then they're talking about doing call credit spreads. So, but then I listened a little bit closer, and that's not really what they say they're going to do. I've heard other people say call credit spreads, but when I listened to it, they said they're going to sell SPX index options, distribute that income to shareholders, and hold some back so that.
And when market conditions warrant, the additional premium may be used to buy an out-of-the-money call to potentially capture upswings of the underlying assets.
So to me, that doesn't clearly define this as necessarily a credit spread that they're doing, but all we know is that they're selling SPX options and then they're distributing some of that money and keeping some of it back so that at their discretion, they can go buy some calls at times in order to deliver some additional income. But it really is up to their discretion and their decisions to turn this into income for the fund.
Something really cool that I don't even know about, and I started feeling what?
I like the idea that they're going with here, but just remember, they're on the hook here right now. They've got 3 ETFs. They're trying to grow. It's a brand new business. What would you do to attract minnows to where the sharks are at? Right? You're going to offer something like this. This is kind of the hook. People see 12%, they're attracted to it, they're drawn to it. Doesn't mean you should buy it just because it's got that high distribution yield. Don't just be sucked in by that. Study it, understand it, and see if it makes sense for your portfolio. And this is the fact sheet from their website. The prospectus is also attached. You can take a look at that. Again, some more heavy reading to understand this fund. But they continue to talk about tax efficiency, and they have their portfolio management team down here, which is Garrett, Troy, and Ryan, forming the NEOS. Maybe, I don't know, who knows. But those 3 guys are your go-to guys, right? And I know Troy and Ryan are the same nationwide guys that run NUSI. I know other people have talked about that. And NUSI had a bad 2022 and part of 2021. It did not perform well, and there's a lot of backlash. They'll be like, oh, NUSI. But this year, in 2023, it's up nicely. So it does depend on when you put your money in, right? It does depend on how it's performing at a certain time. There are going to be ups and downs with different funds. So did not perform well back then, but performing better this year. But those are your go-to guys. These are the guys that are going to be making decisions on these call spreads when they're putting them on and everything else. So you have to have trust in what they're doing here. So if you don't like that, you probably won't like this. But if you like that, maybe that puts a little bit more emphasis on wanting to put some money into SPYI. Now, the rest of this review will be over here on Seeking Alpha. I am a Seeking Alpha affiliate. There are affiliate links down below if you like what you see. I'm personally a fan. That's why I promote it. That's actually why I use it every single day for my own personal research, to jump here and take a look at things like SPYI, for example. And one of my favorite things is you get lots of different analysis. In this case, it's a brand new fund. We only have 2 people chirping in so far, but they both have buy ratings. I guess that's something to be said. But you get analysis from pros and from hobbyists and everything else in here that you can kind of research and read through. And they go into a lot of depth at times. So it can really help you along on your journey to find out what you like and what you don't like when it comes to these types of ETFs. So a lot of this information we've already talked about. We've already talked about the expense ratio, that it's a monthly paying, what the dividend rate looks like, and the yield overall. Now over here, they're showing 8.58% because that's only based on the first part of the year since its inception. So it will gradually increase until they get a full year's worth of information. But again, $84 million of assets under management. So small compared to a lot of the other ones that we talk about. Now holdings are exactly what you'd expect. It's the S&P 500. But just for you guys out there, top 10 holdings are things like Apple, Microsoft, Amazon, NVIDIA. There's one of the options there. First American Treasury, Alphabet, Tesla, Alphabet Class C. And that totals about 35% of the fund are those top 10 right there. Now we can look at the dividends. I know people love to talk about the dividends or distributions in this case, and what you're going to get every single month. And we can do that. We can see that under dividend history. Make sure I can get it over here on the tube here. But this is every single month. So we had 46 cents, 48 cents, 46 cents, 48 cents, 47, 47, 48, 49. So very consistent, a little suspicious, honestly. And again, one of the reasons I want to see a full year tax report from these guys at the end of the year. I would expect more hills and valleys about what they're distributing every month, if they're distributing everything every month, right? That seems a little bit odd. So something that I need to dig into a little bit more and give you a little bit more history on what's going on here. The last thing that I want to show you here on Seeking Alpha is a comparison chart of 3 of the ETFs that we routinely talk about here, along with SPYI. So we're looking at a year-to-date chart because we don't have that much information on SPYI yet, but just looking at it for 2023, which has seen a nice big rally and a few stocks in the queues, along with some nice movement now for things like SPY and the SP 500. We have SPYI in orange, we've got JEPI in blue, we got JEPQ in purple, and Devo in green. And yeah, you can see SPYI year to date has performed quite well, up about 8%. Again, this is just price returns. We're not talking about the distributions that are coming out of the fund as well, but just looking at that. So we got JEPI just over even here at about 0.7%, JEPQ up sharply because it is based on the Qs, and Devo up just a little bit. So yeah, it's holding its own year to date this year. But again, that's not enough information for me to say, yes, this is something I'm going to dump my money into. But pretty interesting that it's held up pretty well so far this year with their strategy. So far, it looks pretty good. So in summary, I would say that this is an interesting fund with some promise, but I don't feel any pressure to jump right into it and buy a bunch of shares and be the first one there. I'm going to wait. I'm going to let it marinate and give me some more information first before I go jumping in and add it to my portfolio. I do like the idea of finding several of these that I can put together when I talk about income ETFs, and it's a small portion of my portfolio. But I mix them all together. My goal here is to not even beat the S&P, because I don't believe that I will beat the S&P with these types of funds. But what I want to do is, if I put $10,000 in there, I don't want any of it back. I don't want any return of capital. I want it to keep that $10,000, maybe increase a little bit over time, but give me that, maybe 8% overall return annually. That's perfect. That's all I want out of that little portion of my portfolio. I'd be happy with that. So if I can mix several of these together, get really diverse, and have that kind of return and lower my beta, that's wonderful. That's exactly what I want. So if you have any questions on any of this, please ask down below. Like and subscribe if you like this type of content, and we'll see you next time. Take care. Whoop.